Welcome to the Matt Waller Podcast, where we look at success at the intersection of technology, logistics, supply chain, retail, and CPG, also known as the retail value chain. I want to clarify that this podcast is distinct from my responsibilities as a professor in the Sam M. Walton College of Business. Nonetheless, it aligns with my aspiration to provide practical insights to professionals and business by showcasing companies and people that can enhance your ability to manage, lead, and strategize and market effectively in the retail value chain. Before we dive into today's exciting episode, I'd like to thank our sponsor, New Road Capital Partners. New Road invests in proven technologies, services, and products that serve unmet needs in the marketplace. They look for companies in supply chain and logistics, as well as consumer-oriented companies. For more information, go to newroadcp.com. I would also like to disclose that I am a strategic advisor to New Road. I'd also like to recognize podcastvideos.com for the services they provide for these podcasts. I'm very pleased with their services. And now, without further ado, let's get into the exciting episode. You're really going to learn a lot from this podcast today about alternative investments. And we're going to be talking a lot about alternative investments in transportation and logistics. We're going to be talking about asymmetric risk-return profiles and many other topics. Eric Adams is who I'm interviewing, and he is Director of Private Capital and a partner at Johnson Financial Group. In this role, he's immediately responsible for the formation, execution, and oversight of the firm's private market investment philosophy and strategies, and he oversees the sourcing and due diligence of private investments, which we talk about, along with the construction and implementation of clients' private capital portfolios. He has an undergraduate degree in cell biology and an MBA, which we talk about, and we talk about how that relates to what he's doing today. We also talk about the fact that he's got a CFA and a CIA and how those are relevant to what he does and whether or not he recommends other people get those kinds of designations that are in this market. But we talk about so many interesting things. We talk about why transportation logistics is a great market to invest in. In fact, Eric has authored a thesis article explaining why he is investing in transportation logistics companies. It's a terrific paper. It's very deep. It goes into the history of logistics and transportation, but it also goes into why it's such an attractive area for investment. So I think you're really going to like this. Eric, thank you so much for joining me today on the podcast. I really appreciate it.
Absolutely. Glad to be here.
Eric, would you mind telling us a little bit about what sparked your interest in investing in transportation logistics companies?
Sure. So I have the good fortune of having a very fascinating job, which entails primarily me scouring the investable universe and trying to find compelling strategies that we think might benefit our clients' portfolios. And we are generalists, and so we're looking all over the asset class spectrum, all over the world. And so that's what eventually led me to transportation logistics, is because just through my networking, my conversations, which is a huge part of my job, it's just out there talking to people smarter than myself who have expertise within specific areas of focus. And through doing that, identifying areas such as transportation logistics, which it's a very disconnected, fragmented area that's very ripe for disruption. There's a lot of white space there for innovation. It's global in nature. There's a lot of there's enough there to keep you interested at all times. It's tied into geopolitics, it's tied into climate. And so, just from an intellectual curiosity perspective, it's something that really piqued my interest. And so, after that point, this is just how I explore all different kinds of industries. You start networking, you start talking to the experts in the space, and I start talking to other investors, LPs out there that have invested in the space already, some general partners, some private equity groups, et cetera, to start to formulate a bit of a thesis internally at our firm and working with my team to really hash that out. And so what attracted us to transportation and logistics is, again, kind of what I already talked about. And it's very fragmented. It's very regional in nature. All over the world, there's room for disruption. There's a lot of white space for innovation. And, in a lot of instances, there's some very strong downside protection available as well, which is something that we're always looking at first, frankly. And all of those things, and just some conversations with some very intelligent investors in the space got me excited.
So when you talk about protection from the downside, how is that provided by the logistics sector?
Well, it certainly depends on the strategy. There are riskier, certainly, strategies within logistics. If you're investing in startups, if you're investing in growth companies that are not yet profitable, that's going to be a little bit farther out on the risk spectrum. However, there are, those are appropriate for client portfolios as well, probably to a smaller extent than some of the more downside protected but lower expected return strategies. And some of those that we've looked at within logistics would be industrial real estate and warehouses, for last mile delivery, et cetera. And so that's real estate, it's tangible, there's tax benefits to investing. Similarly, we've invested in maritime shipping and riverboats, tugboats, towboats, U.S. river system. And again, similar to real estate, those are tangible, real assets that provide real value that it's not going to go up in smoke like a startup company could go to zero. This is real value that at the very least provides some amount of scrap value. But they're in very high demand, and there's a low supply of these vessels, and there is the tax benefit to investing in them. So there's a very strong amount of downside protection in that specific strategy. But again, it certainly runs the spectrum from higher risk, but potentially higher returning, to more downside protection, lower risk, and lower returns. But what we're always looking for is what we call, and I'm kind of rambling at this point, just a touch of a tangent, but is really the asymmetry of the risk return characteristics. And so what I mean by that is you are overcompensated for the amount of risk that you are undertaking. Said a different way, the amount of returns that you're able to generate is above and beyond really the risk that you are undertaking.
That's really a great point. And, every time there's been a recession, transportation decreases a bit, but boy, it's always a great time to invest in transportation because it comes back. Product has to move. People have to survive, and I remember the first time I saw that in a big way at 9/11, around that time frame, and 2008, 2009, and even recently, which was a really, because of the pandemic, it was an extreme example, but it just reminds us that people still have to eat. They need product. Product's going to move. And
absolutely.
And sometimes, If things get too expensive, or if let's say that the economy goes down, there's some modes that do really well, like intermodal. People start shifting more to intermodal because it is less expensive, and they're willing to trade off maybe lead time variability, uncertainty for a lower rate.
Yeah, kind of as I was talking about earlier, it's such a wide-ranging, global, varied space, and it's exciting in the sense that it's volatile and it is subject to geopolitical uncertainty. And you've probably seen recently about how the Red Sea, a lot of shipping has basically shut down through there because of the Yemeni Houthi rebels, and so the Suez Canal, there's extremely low volumes right now. The Panama Canal, is also because of climate. There is a drought down there, and the Panama Canal cannot handle the volumes that they used to. And so it kind of sounds risky or scary potentially as an investor from the outside. And you also see the volatility and spot freight pricing as well. And if we're talking about global shipping, it's $20,000 or so to ship a box. I guess a couple of years ago now, and now it's 2,000, 3,000. So a lot of volatility within the space, but there are ways to approach it that are a little bit more risk aware, if you will, where you're less exposed to spot prices and less exposed to some of those geopolitical risks. But there's certainly no shortage of things to pay attention to.
I agree. It is such an interesting space. And if you're engaged in it, you wind up paying attention to all kinds of global issues, as you were mentioning. But you also pay attention to financial issues, raw materials costs. There's just so much involved in supply chain and logistics. And it's also interesting, I know you and I have talked before about how, logistics and supply chain has really changed the world in so many different ways. So many inventions like the container and standardization of containers.
Absolutely. Yeah, there's a great book, The Box by Levinson. And people underappreciate, I think, just how much transportation and logistics have been intricately involved in the history of the world and humanity, whether that be in the course of military operations. And there's some great books out there that I've read talk about the Civil War and how a big reason for the eventual North victory is because they excelled at transportation and logistics within their military operations, whether that's soldiers, men, or material. They excelled at that and had far greater capabilities than the South did, and that is one of the main reasons why the North was victorious. And so military operations really since the beginning of humanity, but also obviously economic development too, and containers and standardization of containers for global shipping. And anyway, that's a topic that could be expounded upon for hours on end. But it's almost taken for granted, I would say, by I guess the casual observer, because sure, you gotta get things from here to there, and you gotta source materials and manufacture something and ship that product somewhere else, and that's intuitive. It's easy to wrap your head around, but the complexities involved in that entire process, I think, is something that's probably taken for granted by a lot of casual observers out there. And there's just a lot of investable opportunities within that space because there are so many economic tie-ins.
So, Eric, what are some methodologies or strategies you employ to actually find companies to invest in this space. We've been talking about why you were interested in the space at a strategic level, but there is so much white space, there's so much opportunity, but at some point then you have to say, okay, now which firms do I invest in? So how do you go about that?
Well, it starts with sourcing, obviously, and the sourcing of these opportunities is twofold. It's really research and networking. I mean, we're doing a lot of research on our end to really build out these theses, as I was talking about just a few minutes ago, whether that's around transportation and logistics, or, I talked to you recently about how we've done a lot of research in media and entertainment recently as well. And so there's a lot of research on the front end, but kind of commensurate with that is also just, I mean, it sounds super basic, but it's a lot of networking. It's really me and my team getting out there and, again, meeting the experts, meeting the people that are smarter than we are, that are day-to-day intimately involved within these areas, talking to them about who are the groups we need to be talking about that have, the most compelling strategies with a real edge to their investment approach that others are going to have difficulty mimicking. What are the companies out there that are providing true disruption, right? I mean, disruption is a word that has been buzzy over the last 10 to 20 years, but which companies are providing that true innovation, that true disruption that creates a moat around their business and that competitive advantage and should provide them with significant future growth. And so a lot of it is that sourcing just on the front end, which is a lot of relationship building kind of alongside research. And then when we identify an opportunity, and myself and my team at John's Financial Group, we have a very highly structured due diligence process, 4-tiered due diligence process, where we're seeing about 500 to 600 deals a year within the private investment space, because that's where we spend a lot of our time, is within the private markets. That's across private equity and private credit and real assets, all these different asset classes. And then we have a very highly structured process of how we go about whittling that number down, 500 down to 10 to 12 opportunities per year that we are offering to our clients. And so, yeah, that's a full due diligence process. I mean, that's conversations and meetings with these sponsors. It's basically collecting all the data we possibly can on the team. It's background checks, it's track record, it's all the marketing material that they issue, but a lot of industry research as well, a lot of reference calls. Of course, there's the financial modeling, both scouring their financial models or creating our own internally, legal review, legal doc review, and it's a pretty intensive process that for any given opportunity probably is going to take us a few months to identify an opportunity and then eventually approve it for our clients. And so it's a lot of work, but it's all very fascinating because, again, in a very fortunate position of really just trying to source and identify and vet the most compelling opportunities that we can on behalf of our clients.
So, Eric, how do you structure your day? How do you manage and prioritize your activities regarding investment-related activities?
That's a great question, and it's a constant battle. The prioritization is something that you have to constantly focus on. I just read something from a quote from Steve Jobs recently about how prioritization and focus is paramount, and the ability to say no to a lot of very interesting, high value projects in order to focus on what is the number one most important project is a skill and a discipline that not too many have mastered. And, I question whether or not I've mastered that as well. So as far as prioritization goes, my day, how it's structured, there's internal meetings, several per week with my team, with the investments team, where we are identifying new opportunities that we're sourcing, or we are covering where we are in the due diligence process across as many deals that we were underwriting at the time. So there's a lot of teamwork, I would say, at our firm. That's something that we emphasize across all of the different teams within the company. And that's certainly the case within the investments team. And so there's a lot of collaboration, a lot of communication, and a lot of our time is structured underwriting these various opportunities and talking to the sponsors, setting up those conversations and meetings, or just doing the dirty work of that ground level underwriting. And so that used to be a much larger part of my job back when, we were really building the firm, and I was doing a lot of that ground level underwriting myself. But now have a very talented team that helps me out in a lot of that. And so my day is structured more along the lines of oversight, and kind of making sure that we're pushing the ball forward on these various due diligence projects that we're working on, and staying focused. Something that we're always, focusing on is which ones are the best fits for our clients, early on in the process, and which ones can we say no to quickly so as not to spend undue time on those. But a lot of my job is also spent, as I said, networking. A lot of my day is structured just calling on other investors, in similar roles as myself at different firms, talking to them about what are you looking for in 2024. What strategies do you think are set up nicely in this economic environment to benefit from current market dynamics? What specific strategies are you looking at? What should I be looking at? And so a lot of my time is structured also with just networking and talking to other intelligent investors out there. And then I also structure a good amount of my time really researching, thinking, and producing, what we call, thought leadership pieces. And that goes into, the time I've spent with the transportation and logistics memo, which I shared with you, with the entertainment and media and entertainment memo I just completed recently. And so there's a thought leadership component to my time as well. Not to mention speaking with clients, telling them how their previous investments are going, and pitching them on new investment opportunities, and talking to prospective clients that really want to get a deep understanding of our investment platform, our philosophy, our approach, etc. So it's enough to keep me busy.
I bet. Well, I know, and of course, I've read a couple of your theses, but regarding your investment thesis around transportation and logistics,
Mm-hmm.
and we've really touched on this indirectly already a little bit, but how did you go about formulating that thesis, and how has it evolved to fit the current marketplace?
Sure. I laugh only because, transportation and logistics is just constantly in flux. It's amazing. If you look back, as I know you have, on that memo that I wrote a little over a year ago, how much has changed in that time is unbelievable.
It is.
Again, I talked just a few minutes ago about how, it costs $20,000 to ship a container, overseas, a year ago, and now it's, 2,000, 3,000, whatever the current number is right now. So things change drastically. And so you talk about how my thesis has evolved. It has to constantly be evolving along with the marketplace. But how I go about formulating a thesis is just a lot of research, which is difficult. This is all kind of tied together, because you talk about prioritization, and you really have to set aside some time and prioritize research and due diligence. And it's pretty easy to just answer emails all day, and it's not really the highest value activity, but really setting aside some time to create a little brain space to do some research. And so, I read several different books, countless industry reports, countless conversations with industry participants to make sure I was seeing things from all angles, and asking them, who else do I need to be talking to? Can you share with me any of your industry research? And what companies do you think are doing the most exciting things within this space? And following, tracking down those leads constantly. And so it takes some time, some diligence, some brain space, and some dogged determination at times. And it creates, certainly an emphasis on prioritization of my day. But that's what I think is most exciting about my job, is being able to spend that time kind of diving deep into different sectors to really formulate these theses so that I can build a vision for where we need to be focusing our time as investors on behalf of our client dollars. Where do we need to be focusing our time, trying to locate those attractive risk return parameter opportunities for our client portfolios. And so I think it's very appropriate that you just talked about prioritization before you ask this question, because it's a lot of time prioritization, because you have to have the headspace to really think through these topics.
Well, I could tell when I read your thesis on logistics and transportation that you had done a lot of research, deep research, because you looked at the history of the industry, you looked at inventions that have changed the industry, you looked at each of the modes, but I don't know how common that is. I've read lots of theses like that, but I really liked how you didn't use just a surface level approach. You actually took a deep dive. I would think investors would really appreciate that.
That's the hope. Hopefully my clients got something out of that, and at the very least took comforts knowing that we're doing the deep work to try to really flesh out these theses. I think a lot of what it is, again, and I know I've touched on this already several times, but I can't emphasize it enough. I oftentimes describe myself as at times a glorified networker, and it's something that I spend a lot of time on, and I find a ton of value in, again, just finding people that are in this case transportation or logistics on a day-to-day basis, and are experts and have been operators and investors and have spent their careers in the space, because I haven't. I'm not going to be an expert in not only transportation and logistics, but other industries in which we invest. I'm more of a forest guy as opposed to the trees guy, but it's incumbent upon me to know all the smartest trees out there, if you will. if you'll allow me to continue this analogy. But and so that's what I spent a lot of my time doing. That really helped me with that memo in the transportation and logistics space, and being able to identify what is really important, and in a way that I wouldn't have been able to do if I just on my own had tried to research the space.
So when evaluating potential investments, what unique aspects and opportunities within a company are you primarily looking for?
Mm-hmm. As mentioned, we're always really looking at the downside first. What's going to happen if things don't go to plan? Because they never go to plan. So we're stress testing financial models and projections. We're creating scenario analyses to understand, what happens if things don't go as planned. And so we're always very much focused on the downside first, because really a big part of my job is I'm not going to pick all the winners, but we do need to avoid, the losers as much as we possibly can. We need to, maybe there's some opportunities that don't make as much money as we had hoped, but we need to avoid those that are losing money. And we have a very solid track record of doing so, fortunately. And so downside is really where we start. And then, after that, certainly there's, product market fit, there's the team and their experience and expertise and their track record. There's understanding the underlying technology and the team, the organizational structure. There is understanding, obviously, the competition within the space. What is the need, the need that their product or services are meeting? How are they disrupting the space? Or if they're not, explicitly disrupting the space, how are they just doing things better than others are doing it? And what advantage do they have over their peers within the industry? The structure of the investment is something that we spend a lot of time on. Where are we in the capital stack? What kind of structures or liquidation preferences? What kind of governance, is there? What kind of legal protections do we have? Et cetera, et cetera. And then, of course, all of the financial underwriting and, the growth of, revenues and expansion of margins and, earnings growth, et cetera. Valuation, valuation is something that we're very focused on, whether that be, if it's an earlier stage opportunity, you're probably valuing it off revenue, and maybe it's a higher valuation, but at a reasonable price is something that we would look for. If it's a later stage, profitable cash flowing company, probably valuing it off a multiple of earnings and hoping to find something. Competition's increased all over the marketplace. Valuations have gone up significantly over the last 5 to 10 years, and they've come back a little bit in this rising interest rate environment that we've seen in the last couple of years, but they haven't come down significantly. It kind of depends on where you're looking, like early stage venture. Those valuations have certainly come down more. But whether or not it's a screaming deal, we're looking for a attractive valuation. And that kind of gets to where we focus a lot of our time, and that's what we describe oftentimes as the lower middle market. And these are, companies that, maybe enterprise value of 50 to 200 million or something along those lines. Everybody's definition of the lower middle market and middle market is different. Earnings of perhaps 10 million to 50 million or something around those lines. These are companies that are, and it depends on the strategy. I mean, they might not be that big if they're a little bit earlier stage, but just speaking in generalities here, these are companies that may have been around for a long time, may have very proven business models and very capable teams, maybe or may not be profitable, but hopefully have de-risked from a technology perspective, and but are too small to gain the attention of much larger investors in the space. You can throw out many such examples of Blackstone or KKR or Apollo or Carlyle or TPG, who are much larger investors in the space and are throwing around big bucks that they've raised, and it just is not worth their time to focus on some of these smaller opportunities. So they end up competing with each other in the upper end of the market and driving up valuations, which then compresses future expected returns. So if you're looking for some better valuations with still great companies with higher expected future returns, where you're going to find those is on the lower end of the market. So kind of a rambling, long-winded response, but trying to paint a picture here.
Yeah, that's great. And if you wouldn't mind, could you give some specific examples of investments in the transportation area and maybe elaborate a little bit on what led you to those investments?
Mm-hmm. Sure. Well, I mentioned earlier that we're invested in a riverboat strategy, and those are towboats, tugboats, and barges on the U.S. river system, primarily the Mississippi River system and the Gulf Intercoastal Waterway. And so these are carrying essential commodities. I mean, it's corn, it's soybeans, foodstuffs. Obviously that's important for the economy, but it's important for society, obviously, in the creation of food. And it's something that obviously is very important to all of us, but also energy, refined products, chemicals, really these foundational pieces to the economy and manufacturing. And so there's a lot of downside protection in the essential nature of what these vessels are carrying. On top of that, it's a really unique circumstance right now within the space because it's a really imbalanced supply-demand dynamic where the supply of these vessels is very, very low. And there's a lot of older vessels on the river that are going to have to be retired, but there's really not enough new vessels being created to fill that gap from the retired vessels. So what you get is a shrinking supply, shrinking inventory of these towboats, tugboats, but very, very high demand still because these vessels are mission critical to the operators. And again, operators are ag companies, energy companies, chemical companies. They're absolutely mission critical, and shipping your products over water is vastly cheaper than shipping by truck or shipping by rail. And so there's a lot of downside protection to the strategy, and there's a lot of support for rental prices to these operators if you're the owner, and rental growth. It's very inflation protected as well in those rental prices, and it's really an income strategy. I mean, this isn't really sexy venture-like returns. You're not going to get a 10x, 20x type return, but what you're going to get is double-digit income hitting your account if you're an investor, on a quarterly basis. And that income comes with tax shelters as well, because these are real assets that have favorable tax treatment. And even though rates have come up significantly over the last couple of years, double digit, talking 12% type yield is still relatively very attractive, even with rising rates across other classes, and especially with that tax shelter. So that's a great example of us looking for that downside protection and we feel as if we are being overcompensated for the amount of risk which we are undertaking. So that's a great example. Another couple examples on the riskier side of the spectrum would be investments in some of the technological disruptions that are going on within the space. I mean, if that's trucking fleet technologies or freight logistics companies or warehouse management systems. And as you know better than I do, given your experience in the space, there's so many of logistics, is still handled by phone calls and spreadsheets and handshakes, and there's a lot of white space to innovate, to create efficiencies, to create technological scalability within these spaces that'll create better experiences for carriers and shippers and eventually consumers in what has historically been a fairly fragmented kind of area prone to hiccups and susceptible to exogenous events and disruptions. So we're also invested in some of those higher risk and higher expected return opportunities as well.
So you have a interest primarily in the lower middle market. You try to avoid early stage startups, and you've touched on a little bit of why that is, but would you mind elaborating on it just a bit?
Sure. It really comes down to, we really focus on investing within the private markets. And the cat's kind of out of the bag as far as investing in the private markets. When we started this, our company, really, the genesis of the company is a private equity style holding company that, goes back 70 years. Back then, the private markets and alternative investments were truly very alternative. Not everybody had exposure to, private equity, real estate, even, private credit, energy, et cetera. But as the private markets have evolved over time, there's, and this is a good thing, there's greater access to the market for, high net worth families or, really the kind of retail wealth client. There's greater democratization within the space, and that's a good thing. But what it has created is greater competition. And the reason we focus on the lower middle market is there is less competition in that space. And again, I'm not here to tell you that there's no competition, because there certainly is. But when you start looking up market, you start running into a lot of those big firms I mentioned earlier that are competing with each other and driving up valuations and therefore compressing future expected returns. What we're looking for companies that are just as strong, just as healthy, with just as exciting growth prospects that are going to trade at lower valuations. And so we're doing this as a way to really benefit our clients and their portfolios by finding those higher expected returns without taking on a commensurate level of increased risk. And so really where we're focusing on in the lower middle market and within different subsectors and different industries is what areas have really compelling investment fundamentals but are currently undercapitalized and are experiencing less competition from capital than some other spaces might be. And so that's where I spend a lot of my time. Which areas are underbanked, which areas maybe have some complexity premium to them, meaning like your common typical investor maybe looks at transportation and logistics, for example, and says, "Oh, that seems messy and complicated," I'm maybe going to stick to investing in apartments or something that's a little bit easier to wrap my head around. Whereas that complexity premium that, again, keeps a lot of capital out, that keeps competition for opportunities lower. And again, it all comes back to valuation and therefore expected future returns that our clients can expect to achieve.
Makes sense. Now, I know that you also invest alongside private equity firms, and you invest in private equity firms, funds, and when you invest alongside them, you're investing in the same things they're investing in, and but sometimes you invest in private equity funds per se. Would you mind talking a little bit about that strategy?
Absolutely. So you're exactly right. But we will invest in private equity style funds, commitment structures, drawdown vehicles that draw down your commitment over a 3 to 5 year investment period. And that private equity fund style approach, we will also invest directly into businesses as well. And we will also invest directly into real estate and some other sectors and asset classes. Where it oftentimes starts is we will invest in a private equity firm in one of their underlying funds that they're raising. And, we've been doing this, long enough now to where we have a really strong stable of repeat managers that we've worked with and invested with for a long time. But we're always out there trying to find new relationships as well with great groups out there that have some really interesting, compelling investment strategies where they've really carved out a niche and an edge. So we're always on the lookout for new relationships too. And so where a lot of our investing directly into businesses comes from is from co-investing alongside these private equity fund commitments that we have. So oftentimes these private equity funds will have a great opportunity. They're going to invest through their fund, but the size of the opportunity is large enough to where they can't write the check, the entire check out of their fund, or else they'd be running up against some concentration limits within their fund. So they might have some additional capacity to invest in an underlying company that they will then offer out to their limited partners, their investors. And oftentimes you're able to invest in at very favorable economics, maybe hopefully no management fee, no carried interest, and it's just a direct investment on the capital stack of this underlying business. And that's a great way to average down the fee burden that you as an investor are experiencing across the fund and the co-investments when you blend the average fees all together. And also double down on the opportunities that you as an investor have the highest conviction in. We're very selective. We're not investing in all the co-investments that our private equity fund sponsors are offering us. We are selecting which ones that we feel highly convicted about, and we do want to double down on our exposure above and beyond what we are getting through the initial private equity fund investment. So that's been a great way to offer some very compelling opportunities to our clients to invest directly into a really exciting operating business.
Earlier you mentioned that you look for asymmetric risk-return profiles in your investments. And that seems like a really good discipline to have in thinking about investing. Would you mind speaking to that a little bit more?
Sure. It's first and foremost getting an understanding if things go wrong, which they do sometimes, right? Investing is literally at its core is investing into an opportunity that is dependent upon future outcomes, and none of us know what the future holds. And so if you're making hundreds of investments, as we have over the years, there are going to be some that aren't going to meet expectations. Luckily, the vast majority of ours have, but there's going to be those. That's the nature of investing. Future is unpredictable. And so knowing that and being intellectually honest about that, you need to be prepared for what that downside case might look like, and understand as best one can if the company is not able to meet their targets, maybe loses money. What is the salvage value of this investment? Is it a real asset? I've alluded to real assets several times on this call. Is there some salvage value? Because it's a real property that can be utilized for something that might create value. If it's an operating business, what assets do they have on their balance sheet that could be sold to generate some amount of value, or could this company be sold at what valuation, still if their return and earnings targets are not met, and really modeling those out, creating, sensitivity analyses, and really focusing on that downside. And that's really where it all begins. And so, we do something that I think's kind of interesting within our investment committee, is when we are coming to a final vote on an opportunity that we may or may not take to our clients. We ask ourselves, we call it a pre-mortem as opposed to a post-mortem. So let's look out 5 years in advance, 5 years ahead, and let's pretend that this investment did not go to plan. What are the reasons? What are the most likely reasons why that happened? And that's just kind of an interesting thought exercise to go through. You can use that, like just with that riverboat strategy. What are the things that could cause that to go wrong? Maybe there's some hidden supply out there that we are not aware of, that there is a larger influx of a new supply of these vessels that comes to market that we were not anticipating, and that drives down rental rates and we're earning lower income. Maybe the regulatory framework changes. It's a highly regulated environment, and the regulatory framework could change. Maybe the commodities that they're carrying, corn, soybeans, refined products, maybe they plummet in price, which then affects the health of the operators who are renting these vessels. Maybe they go out of business, and there's nobody left to rent these vessels, and obviously you're not earning income as the owner. So those are the questions we're asking ourselves. And we just have to get comfortable with those. If we're like, okay, we can see how, this is happening. We think the probability is low enough to where we're comfortable taking those risks. And so that's where, again, that focus on the downside is really paramount to our due diligence process. And then the asymmetry comes in, again, where you're being overcompensated for that risk. Those, again, if we can just keep talking about the river vessel strategy, we understand those risks. We think that they're non-zero probabilities, but we think that the returns that we can achieve more than compensate us for undertaking that risk. And so that's really where it all comes down to.
Eric, I'd like to shift gears just for a moment and get a little more personal. This has been great. But I know that you had an interest in science when you were younger, and so you pursued a bachelor's degree in cell biology at the undergraduate level, and then later you went and got an MBA, which is a very different field.
Right.
So I'm curious, based on my background, I'm curious as to what made you decide to get an MBA, but also, in your current role, does your undergraduate studies in sciences, particularly in biology, help you in any way today?
Sure. I mean, if we start, back at the very beginning, not a lot of kids growing up, truly understand their passion from a young age. And this is what I want to do for the rest of my career. And, if you would have asked me at a young age what I wanted to do, I would have wanted to play basketball for the University of Kansas and maybe be a paleontologist. I loved, fossils and rocks. And so I think it's kind of a romanticized but very rare instance where anybody really knows from a young age exactly what they want to do, and they go ahead and make that happen, and their career kind of falls in line. And so I was very, very much in the camp of not really knowing what I wanted to do, but I had this fascination from a young age in science, all different kinds of branches of science. Like I said, paleontology and geology, the biology, zoology, and then at an older age, physics and cosmology. And I still do have those fascinations. I still read, really nerdy books on black holes and quasars and neutrinos and things like that my wife is in utter disbelief that I bother reading. But it's really just a fascination with how the world works around us. Once I graduated, or once I got close to graduating, I realized I didn't want to go to med school. I didn't want to be a lab researcher. I didn't want to go into teaching biology. And so I had this thought that I wanted to transition to business. And now it's very vague, and maybe not vague, but a very all-encompassing, very broad segment being business. But that's what I decided to do. I decided to then go to business school, and I really gravitated towards finance. And in my mind, it probably tickles a similar part of the brain, science and numbers and math and analysis. And my undergrad degree was in cell biology. And a lot of that was digging in deep, understanding the underlying mechanics and machinery of cells and organelles and how that builds up into the proper function of tissues and organ systems and organisms. And in a way, I think that relates to investment due diligence too. And I think, again, kind of tickles a similar part of the brain where if I'm underwriting a company, you got to really dig in deep under the hood and understand all the various moving pieces and how those moving pieces contribute on up to the health and thriving of the organism or the business in this sense. And so it was a very natural evolution, if you will. But my career, I think, really developed almost as a form of tinkering. Again, I don't think it's too common where, young professionals understand what they're going to want to do with their career from the get-go. And I think it's very important to try a lot of different things. And you're going to realize what you like and what you don't like about different areas, where you might focus on for your career. And through that kind of tinkering, if you will, you find out what it is you're truly passionate about, because, passion is, it's my belief that passion is something that's developed. It's not necessarily inherent. If you don't, I would tell college age kids or those, just out of college, like, if you don't have like a, hard and true passion right now, like, don't fret about that. You just need to get out there, find something that you're good at. More importantly, once you develop expertise, the passion follows. And I think that's been very true for me. I got into investing. I developed that expertise with investing. I kind of carved out a little bit of niche within the private markets and these esoteric, overlooked, underbanked strategies. And once I developed that expertise, I became very passionate about it. And so that's kind of the long winding road of how I've ended up to where I am.
You know, you mentioned an interest in things like black holes, and there's an author named and professor named Lisa Randall. She wrote a book called Dark Matter.
Have I read her?
Well, you know, I don't know
I'm
much
looking at her books now. I know I don't think I've read any of her books, but that sounds right up my alley.
Well, it's interesting because they didn't know dark matter existed because it doesn't interact with light.
Right.
Yet there is a huge amount of it out there.
Yeah, more than ordinary matter.
Yeah, exactly. And they figured it out based on gravitational forces of it. But it is.
I think it's the way that galaxies spin. They realized that in order to spin at that given velocity or momentum, that there had to be something else there that could not be seen. And that's one way that they were able to hone in on dark matter as a theory, and they still have yet to quite locate it.
Well, you know, I think in business sometimes we can look at, just the obvious and kind of overlook things that aren't so obvious, kind of like dark matter. And one of my favorite quotes is, culture eats strategy for breakfast. And it's one of those things that you can't see it, but it has such a impact on how everything's spinning in a company, if you will. And but there is, I noticed again in reading your theses that you do pay attention to a lot of the things that aren't so obvious on the outside. I think even your approach to the thesis around risk return, asymmetric risk return, is an example of that. It's challenging to figure out. You've got to go at it from a lot of different angles. I do think sometimes scientific approaches or an inclination towards that opens your mind to digging in deeper from an analytics perspective, but also looking at things that might not be so obvious and testing hypotheses around them. I'm also curious, I noticed you have a CFA designation, Chartered Financial Analyst, and I know that's a challenging one to get. You also have a CAIA designation. I'm curious, have those helped you in your career, especially at Johnson Financial Group, and would you recommend those kind of designations to others?
Yeah, so the CFA, it's very difficult to attain, certainly. And for that reason, it has a little bit of a cachet to it. There's a little bit of understanding that if you're able to get that, it doesn't necessarily mean that you're the smartest person in the world. What it probably necessarily means is that you have the ability to focus very intently and work very diligently towards achieving a goal. So, I've done a lot of hiring in my day too. And if I see somebody with a CFA, it at least tells me like, well, perhaps they have a photographic memory, but more likely they, are somebody that works very hard, that creates goals, that works very diligently to achieving those goals and really sticks to it. And so that's a big part of I think what having a CFA communicates. And now certainly it communicates investment expertise as well. The CFA is a very broad curriculum, and so you're covering everything from accounting to ethics to economics to financial valuation. It covers a lot to currency, valuing swaps and derivatives. And there's no way that any one career is actually going to touch on all of those. So chances are, if you're going to get your CFA, you're going to study a lot of things that you're never going to use. Hopefully you study some amount that you are going to use. And I absolutely have used a lot of what I've learned in the CFA, but it's kind of, a mile wide, inch deep is a good way to describe it. Probably more than an inch deep, called mile wide, foot deep, or whatever you want to say, because it does get in the weeds. Certainly, I can attest to that. But there's probably a lot in there that any individual is not actually going to use in their career. But again, it communicates that you're really able to set goals and work hard to achieve them. The CAIA, or CAIA, as it's a little more colloquially known, that is more of a foot wide, mile deep, where it really does focus on alternative investments, as the name implies. And so it's hedge funds, it's real estate, it's private equity, and energy, etc. And now that is actually the curriculum of the Kaya is something that I literally use every single day when I'm analyzing the opportunities that we're looking at, on behalf of our clients. When I was studying for that, 7 years ago or so, I would be analyzing a private equity or real estate opportunity during the day. And then at night, I'd be studying the exact same topics that I was, underwriting during work that day. So there was a lot of overlap in between that curriculum and my day-to-day job. And so for anybody that is interested in alternative investments, I think the Kaya does a great job. CFA is a wonderful baseline for investment knowledge. Kaya drills down deeply into alternative investments, and for someone such as myself, it's something I probably use more frequently, I would say, on a day-to-day basis. I use topics that I learned in the Kaya curriculum.
So one last question, Eric. Can you shed some light on the private market investment philosophy that you adopt at Johnson Financial Group, and how does that differentiate you from other firms in the industry?
Mm-hmm. So, as mentioned earlier, the genesis of our company is as the single family office that was started by our CEO's grandfather to manage the wealth that he generated from what was basically a private equity holding company. And so the roots of the business really is in alternative investments, if you will. And so we have that pedigree, we have that in our DNA. Now, fast forward, the family office was formed in the 70s. And so fast forward 50 years to today, it really is a staple of our investment philosophy and our investment platform that we provide to our clients. So, and it really has to do with access. It has to do with expected future returns. It has to do with efficiencies of markets. And what I mean by all of that is, now we do have our allocations to the public markets. I mean, more so than we do. We've got more dollars in the public markets than we do in the private markets. But the way we approach that is predominantly ETFs, mutual funds that take a kind of enhanced indexing, enhanced beta approach. It's not purely passive. We do have some active management within some of the less efficient asset classes like fixed income and small cap and things like that. But the public markets are undoubtedly, and I'll never tell you that they're perfectly efficient, but they are undoubtedly more efficient than private markets. What I mean by that is that people all over the world have access to a lot of the same opportunities and a lot of the same information to analyze those similar opportunities. And my first job out of my MBA program, I was a public equity, large cap blue chip stock analyst. And there was, I was looking at companies like Walmart and Cisco and Medtronic and these companies that there are tens of thousands of analysts across the globe that are looking at the same companies and they're looking at a lot of the same information. And so what has led to my evolution of my career is the recognition that I can provide better value to my clients in their portfolios by focusing on the private markets. I mean, the big if is if you are able to tolerate a certain amount of illiquidity, which is required in the private markets. Your money's locked up. It's not a publicly traded stock that you can buy and sell every day if you want to. If you can tolerate the illiquidity that the private markets require, there are better valuations. We were talking about valuations earlier. There is decreased access to the same amount or the same opportunities. I was talking earlier about how a lot of my job was as a glorified networker. And that's the reason I do that, is to be able to build out these relationships that allow me to access the most compelling investment opportunities that not everybody out there is going to be able to even know about. And if they do know about it, have the expertise to underwrite it, because it's a differentiated underwriting skill set as well compared to the public market. So there's some different considerations there. And so it all comes back to, how do we build the best, most effective portfolios for our clients that are engineered towards achieving whatever their goal is. If it's growth, if it's income, downside protection, there are those investment policy statements are catered to each client individually. But how do I go about using all the investment structures and asset classes out there? How do I construct the best portfolio possible to meet those client goals and objectives? And we just believe that if you are able to tolerate a certain amount of illiquidity, that having a healthy allocation to private market opportunities is going to help you achieve those goals more effectively, because of limited access, lower valuations, higher future expected returns, lower drawdowns, lower correlation across other asset classes, greater income potential within the private markets relative to the public markets. And it's really that all-encompassing philosophy that has led us to our current portfolio construction process.
Well, Eric, I have really enjoyed this conversation. Your knowledge is very deep, clearly, and I've also enjoyed just getting to know you through our conversations and reading your theses. It's really commendable what you've accomplished there. So I know your time is very valuable. So thank you so much for taking time to dive into these important topics with me today.
Thanks a lot, Matt. I appreciate it. And I hope the listeners find this interesting. I've listened to several of your other podcasts that you've recorded, and I don't know how I'm going to stack up to some of those fantastic interviewees that you've had on, but I did my best, and I appreciate the opportunity, and thank you so much.
If you're finding value in this podcast, we'd greatly appreciate your support by subscribing to our YouTube channel. Additionally, following us on Apple and Spotify and leaving up to a 5-star review would be immensely helpful. We welcome any feedback or questions related to the podcast, as well as suggestions for further topics and guests. You can leave your comments on our YouTube channel, and rest assured that I will read each and every one of them. Please also take a moment to check out our podcast sponsors, as they play a critical role in keeping this podcast running. For more information on specific topics, timestamps, or links to articles mentioned during the podcast, head over to mattwallerpodcast.com.